Hello! Thank you for viewing Accounting. Liabilities by GatorGrades. Let's begin with a question. What does accounting do? Accounting organizes each financial action of a business into accounts. And within these accounts is a category for liabilities. For example, the baskets that present the fruit for sale to customers that we see in this photo could potentially be a liability because the business may have accepted their delivery but not yet paid the vendor the amount owed. The business has the baskets to use, but the seller of the baskets is awaiting a payment. Liability accounts are a group of categories that list the total dollar amount of money that is owed by a business. A liability account is where the business adds together and lists the total dollar amount of the money that is owed. When a business makes a purchase, they may not pay for the items at the time of the purchase. When working with a regular supplier, the business can place an order and the vendor will supply them the items. The vendor will then send an invoice to the business requesting the payment at a future date. This amount of money that is owed will be listed by the business in the accounts payable liability account. Since the business owes the money, it is listed in the accounts payable account as a liability. When the pay an invoice, the amount of the payment made will be deducted and the liability account will have a lower balance. For example, if a business lists $100 in the accounts payable account and makes a $30 payment, the accounts payable account balance will then be equal to $70. There are different types of liability accounts. Some common business liabilities accounts include rent, credit card debt, car loans, salary payable, and taxes payable. Which liability account would increase? Imagine that you own a business and you bought a company car with a loan for $24,000, but have not yet made a payment. Which liability account would increase by $24,000? Considering our 5 different liability account examples on the right, the car loan liability account would increase by $24,000. Example 2. You use the company credit card to pay for $643 in office supplies. Which liability account would increase by $643? Would the rent account increase? No, it would not, because this was an office supplies purchase, and since it was made using your credit card, the credit card debt liability account would increase by $643. Within the liability account group is a category known as contingent liabilities. When a business is sued, money is held in reserve in case a lawsuit is lost. The amount that is held can vary, but this can be a large cost to a business. The funds in the contingent liabilities account can include the preparation costs, insurance, and legal fees related to a lawsuit. Risk management efforts help a business focus on the areas that present a legal risk or can be harmful to the business or people, even with risk management efforts. Sometimes, even with the best efforts, a business can still be sued. A company will keep the amount related to the lawsuit in a separate account to ensure the funds are available to pay if they lose. The funds are held in what is often the contingent liabilities account. What would you do? Imagine you are a business owner and your company has been sued. Let's look at a letter shared by a person who is bringing a lawsuit against the business. The letter reads, I am writing about my dog Banana, who ate too much of your dog food and got sleepy. I could not play with him. He slept so much, I did not go to work. I just waited for him to wake up, and I did not get paid, so I called a lawyer. In your opinion, is this a reasonable lawsuit? Even when a lawsuit is not likely to result in the business owing money, the amount being sued for and possible costs are held in a special account. With this in mind, will the business need to move money from the cash account to the contingent liabilities account? Yes. The contingent liabilities account will hold cash for the lawsuit as long as the lawsuit is still pending and the business cannot use this money for any other reason. Let's discuss another type of liability account, doubtful account. During standard business operations, for a variety of reasons, the business may be owed money that has a low chance of being paid. A doubtful account is one that is owed, but that has a low chance of being paid to a business. An example that includes the use of a doubtful account. A boat factory sells 12 boats at a price of $10,000 each. The total sales revenue for the 12 boats is $120,000. This was computed by multiplying 12 boats times their price of $10,000 each. Half of the customers who purchased the boats received an invoice, and the other half paid at the time of taking the boat home. If the total amount sold was $120,000 and half of the people were added to the accounts receivable accounts, what is the dollar amount added to the accounts receivable account? Did you compute $60,000? If so, then you're correct. The accounts receivable account has a balance of $60,000 that the business is waiting to receive from customers. 1 year passes and only 50% of those that got an invoice have paid. What amount would you add to your doubtful account total? The amount owed from customers was $60,000, and now we have 50% paid their balance. This leaves $30,000 not paid 1 year later. As you can imagine, the business owners are quite sad to no longer have 3 boats in inventory and to not be able to collect the $30,000 they are owed. In this scenario, $30,000 would be added to the doubtful account balance. What is a doubtful account? A doubtful account shows the total amount of money the business is owed from customers. This is money the business earned and is waiting to receive. Let's practice discussing accounts using business terms. On the right side, we see the sentence prompts, and on the left side, we see the information. Example 1. At my business, customers owe $35,000. Since $5,000 has been owed for over 1 year, this amount will move from the accounts receivable account to the doubtful accounts account. With the information provided in the second green rectangle, read the 2 sentences on the right aloud. Did you say, at my business, customers owe $125,000. Since $75,000 has been owed for over 1 year, this amount will move from the account receivable account to the doubtful accounts account. Now try the third green rectangle on the left. Did you say, at my business, customers owe $80,000. Since $10,000 has been owed for over 1 year, this amount will move from the accounts receivable account to the doubtful accounts account. And what about number 4? At my business, customers owe $5,000. Since $4,000 has been owed for over 1 year, this amount will move from the accounts receivable account to the doubtful accounts account. Looking back at these 4 examples, the second green rectangle has the greatest dollar amount of money owed that has not been paid by the customers. Imagine that you went shopping for your business. Looking at the red oval, you purchased a new packing machine and paid by signing a loan agreement at the bank. In which liability account would you record your purchase? Account options on the slide are loans payable, credit cards payable, accounts payable, and rent. By completing the packing machine purchase, you agree to a loan your loans payable account would increase. In the green oval, we see that you purchase new uniform t-shirts with a company credit card. For this example, since your method of payment was a credit card, the credit card payable liability account would increase. You also had 7 cases of water delivered, and the company that delivered it said it would send you an invoice. In this example, your accounts payable account would increase. It's an amount that you agree to pay the water company. In the last example, the purple oval, the monthly lease payment is due. And since this is a rent obligation, your rent liability account would increase as it is an item you owe and will need to pay. Imagine you're a business owner and you're considering offering your customer the option to request an invoice rather than pay at the time of purchase. In the pros column, we see that offering an invoice with a pay later date to customers can help the sale if the customer does not have money to pay on that day. However, in the cons column of providing an invoice option, we see that you will give away your inventory and have to wait to get paid, with the possible risk of not ever getting paid and adding to your doubtful accounts balance. If you were a business owner, which would you decide? Would you require full payment at the time of purchase or provide customers with an option to receive an invoice and pay later? Let's review a few items before we go. What is the accounts payable liability account? Amounts that a business owes but has not yet paid. Invoice, an item that provides customers with purchase details. Liabilities, an expense to a company, items to be paid. Contingent liabilities, legal costs and fines that a business may need to pay in the future. Doubtful accounts, an amount owed to the business that is past due for more than 1 year. Thank you for learning with GatorGrades. To see more videos developed for teen learning, please like and subscribe. I hope to learn with you again soon.